If you ask any seasoned investor about the greatest minds in the world of finance, Charlie Munger's name will almost certainly come up. As the legendary vice chairman of Berkshire Hathaway and Warren Buffett's closest business partner, Munger's wisdom stretches far beyond the confines of Wall Street. His insights touch on human behavior, decision-making, and a unique approach to wealth building. But there's one investment Munger made that stands out, not just for the fortune it created, but for the timeless lesson it teaches. What if I told you that Munger's best investment wasn't just about money? What if its real value was hidden beneath the surface, a principle that could shape how you think about life, business, and opportunity itself? To uncover this lesson, we need to rewind the clock to the early 1970s. At the time, Munger wasn't the billionaire we know today. He was a successful lawyer-turned-investor, but his financial journey was marked by both brilliant decisions and hard-earned failures. And that's where the story of See Candies begins. The early 1970s were turbulent times for the U.S. economy. Rising inflation and uncertainty clouded the financial markets, making many investors nervous. Amid the chaos, an opportunity landed on Munger's desk, a small, family-owned chocolate company based in California called See Candies. At first glance, See's didn't seem extraordinary. It was a regional business with a loyal customer base but modest financials. The company was generating around $30 million in annual revenue, and while it was profitable, it wasn't the kind of fast-growing tech stock that typically turned heads. Yet, Munger saw something others missed, a hidden moat. In investing, a moat refers to a company's ability to protect itself from competition. And See Candies had an invisible advantage: customer loyalty. People didn't just buy See's chocolates, they loved them. Generations of families had a deep emotional connection to the brand, especially during holidays. This brand power made customers willing to pay more for See's products year after year. Munger and Buffett were interested, but there was one problem: the price. The owners of See's wanted $30 million to sell the business. At the time, paying $1 for every dollar of revenue seemed expensive. Most value investors followed the teachings of Benjamin Graham, Buffett's early mentor, who believed in buying businesses at deep discounts, companies that were underpriced based on their assets. See's didn't fit that mold. It had intangible value, its brand, its loyal customers, that didn't show up on a balance sheet. But Munger wasn't bound by rigid formulas. He understood that sometimes the greatest opportunities lie in paying a fair price for a great business rather than chasing cheap companies destined to fail. After careful consideration, Berkshire Hathaway purchased See Candies for $25 million. A price many thought was foolishly high. What happened next would change their investing philosophy forever. What made See's so special wasn't just its tasty chocolates. It was its pricing power. Each year, See's could raise prices slightly without losing customers. While other businesses struggled against inflation, See's simply adjusted its prices and maintained its profitability. Within 5 years, the company had returned its entire purchase price through profits alone. Over the decades, See Candies became a cash-generating machine, delivering over $2 billion in profits to Berkshire Hathaway, all from a $25 million investment. But the real magic wasn't just the money. This investment transformed how Munger and Buffett thought about investing. It taught them a lesson that would shape every decision they made moving forward. It's better to buy a wonderful business at a fair price than a fair business at a wonderful price. And yet, the most profound lesson of all lay beneath the surface. A hidden truth that applies far beyond investing and into everyday life. If the See Candies investment only taught Munger and Buffett to pay a fair price for a wonderful business, that would be lesson enough. But beneath the financial success was a deeper insight, one that applies not only to investing but to how we make decisions in life. To understand this hidden lesson, we need to explore a core principle that Munger often emphasized. The big money is not in the buying or the selling, but in the waiting. When Munger and Buffett bought See Candies, they weren't thinking about quick profits. They didn't plan to flip the company in a few years for a small gain. Instead, they approached it with patience, the belief that long-term value compounds if you nurture it correctly. This patience wasn't just about holding the investment. It reflected a philosophy that many people miss in today's fast-paced world. Consider this: many investors in the 1970s would have passed on See Candies because it wasn't a growth stock. Tech companies and energy firms were the darlings of Wall Street, offering the promise of quick riches. But Munger knew that true wealth isn't built by chasing trends. It's built by owning valuable assets for decades and letting time do the heavy lifting. By holding on to See Candies for over 50 years, Berkshire Hathaway unlocked exponential returns. What started as a modest investment became a cornerstone of their empire, fueling other acquisitions and opportunities. Munger's lesson here is profound. Short-term gains fade. Long-term value lasts. This thinking applies to more than just financial investments. It applies to how you approach your career, relationships, and personal growth. Think about it. How often do people chase instant gratification instead of building something enduring? Whether it's jumping jobs for a small salary bump or seeking short-lived pleasures, the modern world rewards speed. But Munger's story teaches us that the best returns, in money and in life, come from playing the long game. Another hidden insight from the See Candies investment comes from a concept Munger often spoke about: staying within your circle of competence. When the deal came to Munger's attention, he didn't know much about technology or cutting-edge industries, but he understood consumer behavior. He knew that a company like See's, with its loyal customer base and pricing power, was within his circle of competence. Munger believed that investors and decision-makers get into trouble when they stray outside what they truly understand. His advice: knowing what you don't know is more useful than being brilliant. By focusing on businesses he could analyze deeply, Munger avoided many pitfalls that trapped other investors. He wasn't trying to be the smartest person in the room. He was trying to be the most disciplined. This principle applies to anyone making important decisions. Whether you're investing, starting a business, or pursuing a new skill, staying within your circle of competence helps you make better, safer choices. Another overlooked aspect of the See Candies story is the role that reputation played. Munger realized that See's wasn't just selling chocolate. It was selling an experience. Each box of See's represented trust, tradition, and quality. Customers weren't buying candy. They were buying the feeling of sharing something special with their loved ones. That emotional connection was priceless, and it made See's immune to many forms of competition. Munger understood that businesses with strong reputations can charge a premium and still retain loyal customers. This insight became a guiding principle for future Berkshire Hathaway investments, favoring companies with brand equity that couldn't easily be replicated. Think about your own life. Whether you're building a business or a personal brand, your reputation is one of the most valuable assets you have. And like See Candies, if you invest in quality and trust, the returns will multiply over time. At this point, you know that Charlie Munger's investment in See Candies wasn't just about making millions. It was about embracing long-term thinking, staying within your circle of competence, and understanding the intangible value of reputation. But there's another powerful lesson hidden in this story, one that's less obvious but just as impactful: the true cost of missed opportunities. Munger often spoke about a concept that many investors and people ignore at their own peril. Opportunity cost is a huge silent tax on your life. Let's break that down. In simple terms, opportunity cost refers to the value of the choices you don't make. Every time you decide to invest your time, money, or energy into something, you're giving up the opportunity to invest those resources elsewhere. For Munger, the See Candies deal redefined how he and Buffett thought about capital allocation. Before See's, they had a habit of hunting for cheap companies, businesses selling below their book value. But after seeing how profitable a high-quality business could be, they realized something profound. The true cost of a mediocre investment isn't just the money you spend, it's the exceptional investment you could have made instead. For example, imagine you invest $100,000 in a struggling business that barely returns 5% per year. If you had instead invested that same $100,000 in a high-quality company compounding at 20% annually, the difference over decades would be life-changing. This shift in mindset is why Buffett and Munger stopped chasing cigar-butt companies, cheap businesses that might give you one last puff of profit. Instead, they started focusing on great businesses like See Candies, which delivered consistent and growing returns year after year. This lesson isn't limited to investing, it applies to every important decision you make. Think about your career. If you spend years working in a field that doesn't challenge or fulfill you, the cost isn't just the salary you earn, it's the opportunity lost to build a more meaningful, higher-paying career elsewhere. Think about relationships. Investing your energy in the wrong people or unhealthy connections costs you the chance to build stronger, more fulfilling relationships with people who uplift and inspire you. Munger believed that wise people constantly evaluate their choices by asking, "Is this the best use of my time, money, or energy?" By applying this mindset, he avoided wasting precious resources on mediocre opportunities and instead focused on world-class investments like See Candies. One of Munger's most famous quotes is simple but profound. The difference between successful people and really successful people is that really successful people say no to almost everything. The See Candies investment taught him that focus, saying no to 99% of opportunities, is the key to extraordinary outcomes. While other investors chased the latest trends, Munger and Buffett became experts in patience and discipline. They would rather sit on billions of dollars in cash than invest in businesses that didn't meet their high standards. This philosophy allowed them to jump on once-in-a-lifetime opportunities like their $1 billion investment in Coca-Cola in the 1980s. They only recognized the power of brand loyalty because of their earlier experience with See Candies. For Munger, every yes had to pass an invisible test. Is this better than every other opportunity one could pursue? If the answer was no, he walked away without regret. If you want to apply Munger's opportunity cost principle in your own life, here are 3 powerful questions to ask yourself. Is this decision taking me closer to or further from my long-term goals? Whether it's an investment, a new job, or a major life choice, always evaluate if it aligns with your bigger vision. What am I giving up by saying yes to this? Every choice has a hidden cost. Be mindful of the better opportunities you might be sacrificing. Would Charlie Munger say this is a wonderful opportunity or just a fair one? If it's not exceptional, it might not be worth your time. But there's still one more layer to the story, a lesson about the kind of thinking that made Munger not just rich, but one of the wisest minds of our time. By now, we've uncovered how See Candies reshaped Charlie Munger's approach to investing, teaching him the power of long-term thinking, opportunity cost, and the value of saying no. But there's one more insight hiding beneath the surface, an insight that reveals why Munger's mind was truly one of a kind. At the heart of Munger's intellectual brilliance was a concept he called mental models. You must know the big ideas in the big disciplines and use them routinely, all of them, not just a few. This approach allowed Munger to see what others missed. While most investors only focused on financial metrics, Munger drew from a wide range of disciplines, psychology, biology, physics, and even history to make better decisions. A mental model is simply a framework for how the world works. It's a way of understanding reality based on the principles of different fields of knowledge. For example, in psychology, Munger used the concept of incentives to understand human behavior, knowing that people are more likely to act in their self-interest. In physics, he applied inertia, recognizing that a business with a powerful brand like See Candies would be difficult to disrupt. In biology, he relied on Darwin's theory of evolution to understand how companies either adapt or die in changing environments. By combining these mental models, Munger developed a multidisciplinary toolkit that gave him an edge in both investing and life. When evaluating See Candies, Munger didn't just think about revenues and profit margins. He used his mental models to spot hidden advantages that other investors missed. The power of brand loyalty psychology model. See Candies wasn't just a product, it was a tradition. Every box symbolized affection and nostalgia, especially during the holidays. Munger recognized that this emotional connection made customers return year after year, no matter the price. Pricing power economics model. Because See's had a strong brand, they could raise prices without losing customers. This was a moat, a competitive advantage that protected their profits. The Lollapalooza effect. Multiple models working together. Munger coined the term Lollapalooza effect to describe how several forces working together produce outsized results. With See Candies, the combination of customer loyalty, brand strength, and pricing power created a compound effect that made the business more profitable each year. Most investors only saw a small candy company. Munger saw an economic engine. The average person tends to rely on one way of thinking. An engineer solves problems with technical models, while a businessperson focuses on financial models. But Munger believed this narrow thinking was a major weakness. If the only tool you have is a hammer, every problem looks like a nail. Munger's ability to think across disciplines gave him a richer understanding of complex problems. It's why he could see opportunities, like See Candies, that others ignored. If you want to think like Charlie Munger, you need to start collecting mental models. Here are 3 ways to begin. Study across disciplines. Don't just focus on one field, read widely. Explore subjects like psychology, economics, biology, and history. Each will give you a new lens to view the world. Look for patterns. When faced with a decision, ask, what models apply here? By combining insights from different areas, you'll spot patterns others overlook. Apply the always invert principle. One of Munger's favorite techniques was inversion, thinking backward to solve problems. Instead of asking, how can I succeed? Ask, what would cause me to fail? Then, avoid those mistakes. Munger's approach isn't just for investing. It applies to life's biggest decisions. In relationships, understanding incentives helps you see what motivates people. In your career, using opportunity cost prevents you from wasting years on the wrong path. In personal growth, applying inversion helps you avoid destructive habits. By mastering mental models, you make wiser decisions and see opportunities that others miss. But there's still one final lesson, a truth that underpins everything Munger achieved. We've explored how See Candies transformed Charlie Munger's investment philosophy, teaching him the power of long-term thinking, opportunity cost, and mental models. But if you only focus on the financial lessons, you'll miss the most profound insight Munger left behind. His greatest wisdom wasn't just about making money. It was about living a rational, ethical, and meaningful life. At the heart of everything Munger believed was one simple idea. The best thing a human being can do is to help another human being know more. This belief guided the way he thought, invested, and lived. Charlie Munger was obsessed with continuous learning. Even in his 90s, he read hundreds of books a year, ranging from science to philosophy to world history. Why? Because he understood that knowledge compounds just like money. The more you learn, the better your decisions become over time. Munger often said, go to bed a little wiser than you were when you woke up. This simple habit of constantly learning and thinking is what separated him from most people. For Munger, intellectual humility was key. He never assumed he had all the answers. Instead, he actively sought out opposing views to challenge his own beliefs. Lesson for us: never stop learning. Curiosity is your most powerful asset. Read broadly and deeply. Be willing to change your mind when the evidence demands it. Unlike many billionaires, Munger never viewed wealth as a status symbol. For him, money was simply a tool, a byproduct of rational decisions and ethical behavior. He believed that character mattered more than intelligence, often saying, it's so simple to spend your life aiming to be rational, honest, and dependable. In fact, the See Candies investment was a perfect example of his ethical philosophy. Despite having the power to squeeze every penny from the business, Munger and Buffett prioritized fairness to employees, customers, and the community. They didn't chase short-term profits at the expense of long-term relationships. And that ethical approach led to decades of success. Lesson for us: in a world obsessed with shortcuts, integrity is a competitive advantage. Do the right thing even when it's hard. Munger believed that most failures in life weren't due to lacking genius, but from avoidable mistakes. His solution: avoid stupidity. He once said, it is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. This anti-fragile mindset is why he loved inversion, the practice of thinking backward. Instead of asking, how do I succeed? Munger would ask, what are the common causes of failure, and how do I avoid them? This method saved him from reckless decisions and common pitfalls that trap others. Lesson for us: don't try to be brilliant, just avoid being foolish. Identify the big mistakes in life: bad investments, toxic relationships, poor health choices, and steer clear of them. Charlie Munger's story isn't just about making billions. It's about a lifetime of principled thinking and rational decision-making. The See Candies investment was a turning point because it taught him the power of quality, not just in businesses, but in ideas, relationships, and life choices. His lasting legacy can be summarized in these core principles. Play the long game, be patient. The best rewards come to those who invest in long-term value. Focus on quality. Whether it's a business or a friendship, quality always wins over quantity. Think multidimensionally. Use mental models from diverse fields to see reality clearly. Avoid dumb mistakes. Success is often about not doing the things that lead to failure. Stay ethical. In every decision, prioritize integrity. It compounds over time. You don't need to be a billionaire to apply Munger's wisdom. Whether you're managing your career, your investments, or your relationships, these lessons are universal. Be curious, never stop learning. Think deeply, always ask, what is the second-order consequence of this decision? Act ethically because your reputation is priceless. Charlie Munger didn't just teach us how to get rich, he taught us how to get wise. And perhaps that's the greatest investment of all. So the next time you're faced with a big decision, whether financial or personal, ask yourself, what would Charlie Munger do?